Okay, let's unpack this. We often think of the global financial system as this, solid bedrock of stability, right?
Right, something immutable.
Exactly. But what if that stability is, well, maybe more fragile than we tend to imagine?
Hmm.
Today, we're doing a deep dive into the moments the foundation really cracked. The 5 absolute largest bank collapses in history.
And for you, the listener, this isn't just looking back. It's really a way to grasp these huge vulnerabilities, these systemic risks that can bring down giants.
Definitely. Some real aha moments in here. Now, to properly compare these fallen giants and really get the scale, we had to be rigorous.
Yeah, defining biggest is key.
Right. So we used total assets at the time they collapsed. But then, crucially, we converted everything to 2024 US dollars.
Which strips out all those distortions from inflation and currency changes over time, gives you a clean comparison.
And as we crunched those numbers, something just jumped out immediately: the timing. Was it just some wild coincidence that all 5 of the biggest collapses happened within, what, a few weeks? Back in 2008?
That's the crux of it, isn't it? This 2008 singularity, as we're calling it, it tells you this wasn't just a few separate banks failing.
It was one event.
One single massive transatlantic firestorm. One bank's problems just fed the next, like dominoes falling faster and bigger than ever before.
A cascade.
Precisely. And the ranking itself, when you adjust the numbers, it tells a story that often gets missed. The sheer size of the European bank failures.
Right, bigger than the US ones.
Oh, significantly. I mean, look at the Royal Bank of Scotland. Its balance sheet dwarfed Lehman Brothers, more than 6 times larger.
Wow. Okay, that completely reframes how we often think about the global financial crisis, doesn't it?
Absolutely. It wasn't just an American subprime issue spreading outwards. It was deeply transatlantic, multiple epicenters of massive risk.
So get ready. We're going to explore the staggering scale of these 5. Royal Bank of Scotland, Lehman Brothers, Fortis Group, Dexia Group, and Washington Mutual.
A rogues gallery of fallen titans.
And our journey into this cataclysm, it doesn't actually start in New York, like you might expect.
No, surprisingly not.
We start in Scotland, with an institution that, for literally centuries, was the picture of quiet conservatism. Royal Bank of Scotland, RBS.
Founded way back in 1727 in Edinburgh. 2 centuries plus of being this respected, almost staid Scottish bank.
But then, the early 2000s hit. New CEO, Fred Goodwin. And suddenly, it's hyper-aggressive global expansion.
The ambition was off the charts. They wanted to be a global financial supermarket. And briefly, in 2008, they were the world's largest bank by assets.
How does a culture shift that dramatically, that quickly, and so disastrously?
Well, that's a core lesson right there, isn't it? Deeply ingrained conservatism can just evaporate under unchecked ambition and, frankly, aggressive leadership.
Leading to this sort of cultural blindness to the risks they were taking on.
Exactly. And the growth itself, fueled by buying up company after company, relentless acquisitions, which totally changed their risk profile. They went from traditional lending to, volatile global investment banking.
And the final nail.
The final nail, the direct cause, was leading that consortium bid to buy the Dutch bank ABN AMRO in 2007. That was the deal from hell.
Right. The bidding war with Barclays. RBS's group won, paying $71 billion. RBS took the biggest chunk, including ABN's investment banking.
And it was a strategic catastrophe, just awful timing. First, they bought it right at the absolute peak of the market, just as the subprime crisis was starting to rumble.
So they massively overpaid. The classic winner's curse.
Textbook case. Second, the due diligence was, well, nowhere near adequate. They didn't grasp the risks hidden on ABN AMRO's books.
But the critical thing was the impact on RBS itself.
Utterly critical. The deal just vaporized RBS's capital, its liquidity buffers, gone. It massively increased their exposure to risky trading assets, complex credit products, right when the rules around capital were frankly deficient.
Leaving them dangerously leveraged.
Dangerously leveraged and totally dependent on short-term wholesale funding. Money they had to borrow constantly just to keep operating.
And when those markets froze, game over. But how fast did it really happen? Was it a slow decline?
Shockingly fast. Not a slow bleed at all. A sudden implosion. We're talking hours. October 7th, 2008, the bank effectively failed.
Just where RBS collapsed.
Plunged 35% in one day. The chairman, Sir Tom McKillop, had to make this desperate call to the UK Chancellor, Alistair Darling.
Saying what?
Saying the world's largest bank would run out of cash by the afternoon. The Bank of England had to secretly pump in tens of billions in emergency liquidity assistance just to keep the lights on.
Wow. Secretly. And then Goodwin.
By October 8th, after frantic all-night meetings, Goodwin gave in. The UK government announced this unprecedented rescue package, $500 billion for the whole UK banking system.
And for RBS specifically.
Initially, $20 billion earmarked just for RBS. It was one of the biggest state bailouts in history.
The scale is just mind-boggling. £2.22 trillion in assets at its peak. That's bigger than the UK's entire GDP at the time.
It's almost impossible to comprehend.
For those of us, outside finance, what does a bailout that big actually mean for the average person, the taxpayer? Is it just a huge number or does it hit home?
Oh, it definitely hits home. It's not just a number. It means the government. So ultimately, the taxpayer is taking on this colossal risk, potential losses, to stop a complete meltdown of everything.
Which impacts public services, future growth.
Everything. And for RBS, it didn't stop there. A second bailout in December 2009 pushed the total government investment to $45.5 billion.
Leaving the taxpayer owning
84% of the bank. The next decade was just this painful state-controlled restructuring. They had to shrink the balance sheet by over 70%.
Huge losses reported too, right?
Staggering. $24 billion loss for 2008 alone. They kept posting losses until 2017. The official estimate puts the final net loss to the UK taxpayer at $35.5 billion.
Just a stark reminder of what happens with unchecked ambition, strategic mistakes, and, well, a massive failure of governance.
A monument to it, really.
Okay, so RBS, a story of global ambition gone wrong. Let's cross the Atlantic now. A different kind of giant collapsing for reasons that were, well, similar in some ways, but also pretty distinct.
Yes, the one that really sent shockwaves through the U.S. system.
Lehman Brothers.
Yeah.
Iconic name. Founded way back, 1850, 3 immigrant brothers trading cotton.
And it grew into this Wall Street powerhouse, fourth largest U.S. investment bank by 2008.
Under CEO Richard Fuld, it had this reputation, didn't it? Aggressive risk-taking.
Very much so. Big in investment banking, sales, and trading, all financed with huge leverage, borrowing heavily, and relying again on those short-term funding markets.
And their role in the housing bubble, they weren't just bystanders.
Oh no, far from it. They were architects. They dived headfirst into the mortgage market, bought up subprime lenders. By 2007, they were the #1 underwriter of mortgage-backed securities on Wall Street.
Which meant their own books were loaded with
real estate risk. $111 billion in commercial and residential property assets. That was 4 times their entire shareholder equity. Just massive exposure.
That level of leverage is, well, astonishing. Something like 30 to 1. What does that actually mean for how vulnerable a bank is, and how is that even allowed?
It means they're skating on incredibly thin ice. Imagine you've borrowed $30 for every $1 you actually have. If the value of what you bought with that borrowed money dips just a tiny bit,
Back out.
instantly, a mere 3.3% drop in their asset values would make Lehman insolvent. And to hide just how precarious it was, they used this accounting trick, Repo 105.
Repo 105, what was that?
Basically a fancy way to temporarily move assets off their balance sheet right at the end of a quarter. Made them look less indebted than they really were. They'd sell them, then buy them back a few days later.
So, misleading investors and regulators about their true debt levels.
Precisely. It allowed that dangerous leverage to continue, largely hidden from view.
A ticking time bomb. And it exploded over that dramatic weekend in September 2008.
Lehman was teetering. U.S. Treasury Secretary Hank Paulson, New York Fed President Tim Geithner, they hauled all the Wall Street heads in, tried to force a private sector rescue. No public money.
Bank of America and Barclays were interested.
They were the main suitors. But the deals fell apart. BOFA wanted government help to cover Lehman's toxic mortgage losses.
Yeah.
Paulson said no.
And Barclays.
That looked more promising for a bit. But then the UK regulators stepped in. They refused to approve the deal unless the US government guaranteed it. They didn't want Barclays importing Lehman's huge problems into the UK system.
Understandable given what was happening with RBS.
Absolutely, they'd seen enough risk.
So no private buyer. And Paulson and Fed Chair Ben Bernanke made this huge controversial call. Let Lehman fail.
Yeah, a massive decision. Their argument was they lacked the legal authority for a bailout, unlike with Bear Stearns earlier. Plus, huge political pressure not to use taxpayer money again.
And the whole moral hazard argument too, right? Don't encourage bad behavior by always rescuing firms.
Exactly. The idea was if you bail them out, they'll just take bigger risks next time, expecting another rescue. They wanted to impose market discipline.
But the consequences.
Immediate. Catastrophic.
Yeah.
Early hours of Monday, September 15th, 2008, Lehman Brothers Holdings files for Chapter 11 bankruptcy.
With assets of
$639 billion. Still the largest bankruptcy filing in U.S. history. by far.
And the ripple effect. It wasn't just Lehman. It went global.
Instantly. Triggered a run on a major money market fund, the Reserve Primary Fund, caused it to break the buck, fall below $1 per share value. That froze the commercial paper market, crucial short-term funding for companies.
Credit markets seized up worldwide. Stock markets plunged.
Global markets just went into free fall, wiped out something like $10 trillion in market value in the weeks that followed.
And Lehman itself was just carved up.
Sold off in pieces, yeah. Barclays actually ended up buying its North American operations for a bargain price. Nomura Holdings got the Asian and European bits.
So letting Lehman fail was a deliberate choice, market discipline. But they misjudged the impact.
Catastrophically misjudged its systemic importance. The complex web of connections, who owed what, to whom the counterparty risk. It wasn't just one firm failing, it was like pulling a keystone out of an arch. Total collapse of confidence.
Okay, from that direct shock of Lehman, let's pivot back to Europe. Another giant that buckled under the 2008 strain, but with maybe a different set of issues. Fortis Group.
Right, Fortis. Interesting case. It was actually a pioneer of European integration, formed in 1990 from a cross-border merger. Belgian and Dutch banking and insurance firms coming together.
Dual headquarters, Brussels and Utrecht, a symbol of that European project.
Very much so. And by 2008, it was huge. 20th largest financial services firm globally. Assets around $876 billion.
But its downfall, similar to RBS.
Directly linked, yes. Back to that disastrous ABN AMRO acquisition in 2007. Fortis committed $24 billion to that deal. They took on ABN's Dutch retail banking and global private banking.
Financed with debt.
Lots of debt, which stretched its capital base right to the breaking point. It exposed just how weak their funding structure was, how vulnerable they were on liquidity, right when those global credit markets were seizing up.
Left them with this massive balance sheet they suddenly couldn't finance.
Exactly. And what happened next really showed how quickly that idea of cross-border cooperation can just shatter under pressure.
Right, September 2008, post-Lehman. Fortis couldn't get short-term funding. Liquidity crisis. And a run.
A massive run, both depositors pulling money out and institutional creditors refusing to lend.
So the governments had to step in. Belgium, Netherlands, Luxembourg.
On September 28th, they announced a coordinated bailout. $11.2 billion capital injection. Looked like cooperation.
But it didn't work.
Failed to restore confidence. Markets were too spooked. And then, just days later, October 3rd, the Dutch government did something dramatic and unilateral.
What was that?
They just abandoned the joint approach, fully nationalized all of Fortis's Dutch operations for $16.8 billion. Effectively broke up the group right there.
Wow, just pulled their part out, leaving Belgium and Luxembourg holding
a collapsing bank. They were forced to act fast. On October 5th, the Belgian government nationalized its banking arm too, and immediately cut a deal to sell 75% of it to the French bank BNP Paribas.
So the resolution was just messy.
Chaotic, value destructive, driven entirely by competing national interests. The supposedly integrated European bank was just carved up along national lines.
Dutch parts became a new state-owned ABN AMRO. Belgian bank absorbed by BNP Paribas.
Right, and they created a bad bank, Royal Park Investments, to dump the toxic assets into. It was a mess. It really highlighted this problem. A bank could be European in life, but national in death.
When the crunch came, cooperation vanished. Everyone protected their own.
Exactly, and that chaos was actually a major reason why the EU later pushed for the creation of its banking union to try and prevent that happening again.
Interesting. Okay, that brings us to another European institution, one that seemed maybe conservative on the surface, but had this critical hidden weakness, Dexia Group.
Dexia, Franco-Belgian, formed in '96. And yeah, its business looked incredibly safe, didn't it? World's largest lender to municipalities, public sector bodies, you'd think low risk.
Huge balance sheet too. $651 billion in assets at its peak in 2008.
But underneath that seemingly safe surface was a fatal flaw, a really extreme mismatch between its assets and liabilities.
Meaning?
Imagine borrowing money that you have to pay back next week. Very short-term borrowing, but using it to fund a loan to a town council that won't be repaid for 20 or 30 years. Long-term assets.
That sounds inherently unstable.
It is. Dexia had billions and billions of these long-term loans funded by incredibly short-term wholesale borrowing. Not stable customer deposits, but money borrowed daily or weekly from other banks and institutions.
Making them hyper-vulnerable to any freeze in those short-term markets.
Exquisitely vulnerable, which leads to its rather unique distinction.
Right, the only bank on our list that basically collapsed twice.
Indeed. Collapse number one. directly after Lehman in September 2008. Those interbank lending markets Dexia relied on just slammed shut. Immediate liquidity crisis. Made worse because they also had some exposure to U.S. subprime stuff.
So another bailout.
Yeah, emergency capital injection, yes. $6.4 billion from France, Belgium, and Luxembourg.
But that just plugged the immediate hole. Didn't fix the underlying problem.
Exactly. It addressed the liquidity crisis, but not that fundamental structural weakness, the asset-liability mismatch. So fast forward 3 years, 2011.
The Eurozone sovereign debt crisis.
And Dexia is right at the epicenter. Why? Because it held massive amounts of government bonds from peripheral European countries, Greece, Italy, Spain, over $22 billion worth.
So its own balance sheet became like a proxy for the health of the entire Eurozone.
Precisely. As the value of those bonds crashed, Dexia's solvency was toast. Triggered another run, much worse this time. Its final irreversible collapse.
And the governments had to step in again, but differently this time.
Autumn 2011, the first rescue plan just unraveled completely. France and Belgium intervened decisively, but this time to dismantle the group properly.
Another capital injection.
Yes, $5.5 billion. But more importantly, the governments provided these absolutely staggering funding guarantees for Dexia's bad bank portfolio, wound up reaching $85 billion eventually.
$85 billion in guarantees. Wow. And the good bits.
The viable parts, like Dexia Bank Belgium, were fully nationalized by Belgium, rebranded as Belfius, still exists today.
And the rest. The original Dexia SA
became purely a bad bank, just a legal entity left to manage the slow, orderly wind down of that massive portfolio of toxic legacy assets, a process that's still ongoing more than a decade later. It's effectively a ward of the French and Belgian states.
So Dexia's story really shows two things.
Two powerful lessons, I think. One, how a seemingly low-risk asset strategy lending to towns becomes fatal when you pair it with a super high-risk funding strategy. That mismatch.
And the second?
That a bailout, just fixing liquidity without forcing fundamental restructuring, is just kicking the can down the road. The 2008 fix left Dexia as this zombie bank, just waiting for the next shock, which duly arrived.
Okay, our final titan takes us back to the U.S. Washington Mutual. WAMU. Big name on the West Coast. Started way back, 1889, after the Great Seattle Fire. Just a small building and loan association.
But under CEO Kerry Killinger, it grew massively, became America's largest thrift institution, pursued really rapid growth.
And that growth led it straight into high-risk mortgages, particularly these option ARM adjustable rate mortgages, and tons of subprime loans. WAMU became a central engine pumping out fuel for the U.S. housing bubble.
So while the Wall Street banks packaged and sold the risky stuff,
WAMU was a primary manufacturer of the toxic loans themselves at the retail level. Their internal culture famously summed up by their motto, the power of yes.
The power of yes.
Yeah, it basically meant loan officers were heavily incentivized just to say yes, approve loans, generate volume, much less focus on actually checking if borrowers could, repay. Were risk managers ignored?
Reportedly, yes. People who raised red flags were sidelined or even fired.
Yeah.
A really dangerous culture.
And was their business model itself structured to amplify this?
Oh, absolutely. Heavy concentration in the hottest, bubbliest housing markets. Think California, Florida. When those bubbles burst, WAMU's loan book was just decimated.
And they used the originate to distribute model.
Exactly. Make vast numbers of these risky option ARMs and subprime loans, then quickly sell them off to Wall Street to be packaged into securities.
Which got the risk off their books.
Well, it transferred the long-term credit risk to investors. And it freed up WAMU's capital so they could go originate even more high-risk loans. A really vicious cycle.
Until Lehman failed, September 15th, 2008. That shattered confidence completely.
And for WAMU, already known to be struggling, the effect was electric. From September 15th to the 25th, depositors just panicked.
A bank run, but digital this time.
A massive, sustained bank run, supercharged by online banking, people moving money with a click. Over just 10 days, customers pulled out a staggering $16.7 billion.
Which meant?
The liquidity completely gone. On September 25th, the Office of Thrift Supervision, WAMU's regulator, seized the bank, put it into FDIC receivership, Federal Deposit Insurance Corporation.
And its size.
$307 billion in assets. It was, and still is, the largest bank failure in U.S. history. Bigger than Lehman in asset terms at failure, though Lehman was a holding company bankruptcy.
And the FDIC's handling of it was different.
A model of swift, decisive regulatory action, really. The FDIC immediately engineered an overnight sale of WAMU's core banking operations, the branches, the deposits, to JP Morgan Chase.
Prominent price.
Bargain price, $1.9 billion. And the key thing was how they structured it. It ensured all the banking services continued without interruption. All depositors were protected, even those over the insurance limit.
But shareholders and bondholders?
Wiped out. Their claims were left with the bankrupt holding company's shell. Worthless. The FDIC's goal was achieved. Resolve the bank at zero cost to the deposit insurance fund. Taxpayers weren't on the hook.
So WAMU really represents the failure of that originate-to-distribute model at the street level. Plus, a classic bank run, just accelerated by digital speed.
Exactly. The speed was unprecedented.
Okay, so we've looked at these 5 giants individually. RBS, Lehman, Fortis, Dexia, WAMU. When you pull back, what are the universal truths here? What common threads link these massive failures?
Well, you're right. Each story has its unique twists. But yeah, common pathologies definitely emerge. Strategic hubris, really flawed acquisitions that was central for RBS and Fortis. That ABN Amaro deal was just textbook overreach.
Built their balance sheets.
Fatally compromised them. Then for Dexia, the killer was that structural flaw, the asset-liability mismatch, funding long-term illiquid stuff with short-term volatile money.
And the American failures, WAMU and Lehman.
There, it was more about the assets themselves being toxic, combined with reckless underwriting. WAMU churning out bad loans, Lehman packaging, leveraging, and spreading them globally, using accounting tricks like Repo 105 to hide the danger.
And across all 5, any universal themes?
Oh yeah, excessive leverage almost everywhere. Over-reliance on that shaky wholesale funding instead of stable deposits. And, let's be honest, profound regulatory and supervisory failures. Regulators either didn't have the power, the foresight, or maybe the will to rein in the reckless risk-taking before it was too late.
But the outcomes, how authorities responded, differed dramatically, didn't they? A real test of too big to fail.
Stark differences. The U.S., with Lehman, made that conscious choice. Market discipline, let it go bankrupt. Argued they lacked the legal path for a bailout, wanted to curb moral hazard, but they massively underestimated the systemic shockwave.
Whereas in Europe,
for RBS, Fortis, Dexia, totally different. These banks were so huge relative to their national economies, letting them fail seemed unthinkable. So governments intervened on a colossal scale. Nationalizations, huge taxpayer bailouts, years of state ownership. Preventing contagion was the absolute priority, whatever the cost.
and WAMU fits a more traditional U.S. model.
Right. The FDIC playbook for commercial bank failure: seize it, protect all depositors, sell the good bits overnight to a healthy bank. That prioritizes keeping the payment system running and protecting the deposit insurance fund while wiping out the failed bank's owners and creditors. It's also worth noting how the runs happened. WAMU was the most classic retail depositors panicking, but super fast because of online banking.
Whereas the others?
RBS, Fortis, Dexia, Lehman, those were primarily institutional runs. Not queues outside branches, but a silent electronic bleeding of funds. Hedge funds, money market funds, other banks just refusing to roll over those vital short-term loans.
Much faster, more systemically dangerous.
Or faster, yeah.
So stepping back from the details, what does this all mean for us, for the financial system today? We've seen the hubris at RBS, the accounting games at Lehman, the cross-border breakdown at Fortis, Dexia's funding flaw, WAMU's digital run.
And the different government responses, bankruptcy, bailout, seizures, a real-world laboratory for too big to fail.
The good news, I suppose, is that these disasters did trigger change.
Oh, absolutely. A regulatory revolution, really. Landmark laws like Dodd-Frank in the US, the Vickers Report in the UK leading to ring fencing, the EU's banking union, the global Basel III accords strengthening capital and liquidity rules.
The system is definitely stronger now.
More resilient.
Significantly stronger. Higher capital buffers, more liquidity, new tools for regulators like orderly liquidation authorities.
Yeah.
Banks are generally safer.
The big question remains, have all the fault lines actually been fixed? I mean, we just need to look at 2023, right? The U.S. regional bank crisis.
Exactly. Silicon Valley Bank, Signature, First Republic, that was a huge wake-up call, a reminder that new vulnerabilities pop up.
And that crisis wasn't driven by bad loans like in 2008.
No, it was driven by massive exposure to interest rate risk when rates shot up, combined again with the incredible speed of a digital bank run fueled by social media panic.
So the next big threat might not look like the last one. Almost certainly won't. It might not come from subprime or complex derivatives again. Maybe the non-bank financial sector, shadow banking, maybe the whole digital asset, crypto world. or something completely different, like a massive cyber attack crippling a major institution.
The enduring lesson, then, from these 5 fallen giants is that stability isn't something you achieve and then forget about.
Not at all. It needs constant vigilance. Regulators have to adapt. And we all need the humility to accept that the next crisis will probably surprise us. It'll look different.
So looking ahead, what new financial challenges do you think we, and you, the listener, should really be keeping an eye on now?